my fear is that once all these things come in place and you have a central bank that's slashing interest rates on the short end, when inflation has been above the Fed's target for 50 months in a row, and it's rising further away from that target, and then you slash interest rates in the context of $2 trillion deficits, we're gonna add another $30 trillion to the debt in the next decade. I've seen this before. I know how it ends.
The U.S. stock market and the economy are moving further and further apart. The top 10 stocks on the S&P 500 are now worth 40% of the entire market cap. What is happening? What is going wrong? Because the real economy, we've just seen the jobs report, is not doing so well. We're adding less and less jobs, and this is the weakest labor market in the last 15 years. What usually follows is a recession. I've invited Michael Pento of Pento Portfolio Strategies to discuss where are we at in the cycle. Last time we spoke, he was he was referring to a 40 to 50% correction in the markets just to get back to historical norms. Where are we here? We're trading at almost 6,400 in the S&P 500, so we have to discuss this matter. Lots and lots to just really pack into the next 30 minutes. Before I switch over to my guest, quick shout out to the Cairns Harborside Hotel, letting me use their conference room. Much, much appreciated. But also, don't forget to hit that like and subscribe button. It really helps us bring in fantastic guests like Michael onto the program. Now, Michael, thank you so much for joining us here on Soar Financially. Good to see you again.
Great to be with you, Guy.
Yeah, really looking forward to the next 30 minutes with you, Michael. We have lots to discuss because we haven't even talked after the tariff announcement, Liberation Day. Let's talk real market or markets versus real economy. Where do we stand on this matter right now? Let's start broadly here.
Well, the market cap of equities is now over twice the level of GDP. That's something that hardly ever happens in history. In fact, it happened just after post-COVID time. But before that, you look at the average, it's like 100%, a little bit less than that. So why is the market trading at 2 times the GDP? Excuse me. I can only conclude we've had decades of falsified interest rates where real interest rates have been negative for most of the past 20 years. And that's also something that has never happened before. So you have a triumvirate of bubbles. And, yeah, I know I've been saying that they're going to crash. They've crashed before. It's not like they've never crashed before. They've crashed before. They're going to crash again. And getting the timing right is what my model is all about. Does it look like they're going to crash tomorrow? No, it doesn't, Kai. But if you look at the quiescence in credit spreads and you look at the quiescence in financial conditions, hey, this gambling carnival show is going to carry on for a little while longer, but it will end and it's going to be devastating. It is the most overvalued and most concentrated equity bubble in history. And you can add to that a credit bubble and you can add to that a real estate bubble. It has never happened before. We had three concurrent bubbles that are epic in proportion, and they'll pop and they'll be devastating. Getting the timing right and being able to short that is what Pento Portfolio Strategies is all about.
Yeah, it's an interesting time in the market because at the same time, while the real economy is obviously struggling, the labor market is the best indicator for this. Quarterly earnings are at record levels. Like the companies are doing well. Like how do you explain that discrepancy, Michael?
Well, I guess pro forma earnings are wonderful, and you can buy back your stock with engineering. But in the Q1 earnings, according to the Nipper tables, were negative. So I wouldn't go over your skis here. Yeah, we have an equity bubble. That's I'm old enough to remember 1999 and Cisco Systems laying all the fiber optic cable and switches and routers, and that was the technology of the day. And was it a real technology? Absolutely. Was Cisco a real company? Absolutely. Did it still drop 80% in between 2001 and 2003? Yeah, it did. So I'm looking for something similar to happen again. It's just getting the timing right. That's what we need to do.
Yeah, we need to talk about some of the indicators, though, of potential breakdowns. Jobs report last Friday, which was a disaster because it included 2 revisions to May and June numbers as well.
It was really a really bad report. And here's one of the things I worry about. So I voted for Donald Trump twice. So don't accuse me of being anti-Trump or anti-Republican. I'm actually a libertarian, so I'm further to the right than the Republicans. But the average revision under Donald Trump has been 77,000 jobs reduced, the average monthly reduction in 2025. So if this was some kind of conspiracy on the part of the Department of Labor and the Bureau of Labor Statistics, which is the division of the DOL, Why report such strong numbers up front? And then when no one's really paying attention, revise them? That wouldn't make any sense to me. But yet we have an administration that's not only trying to, they blame this lady, Erica, who's the head of the BLS, that she's gone, she's fired because she deliberately, supposedly rigged the numbers. Listen, the numbers are horrible. The data calculation is abhorrent. The agency needs to be revamped and overhauled. But to claim that it's political against Republicans, I think, is ridiculous. And it's the exact opposite. So if you want to accuse the agency of doing anything, the Bureau of Labor Statistics, it's overstating job growth and then having to reveal the truth later in arrears. And if you look at the other target of the administration, which is the Federal Reserve, the problem with the Federal Reserve isn't that they keep interest rates too high perpetually. It's that they've manipulated them artificially too low for too long. And that is why we have such a tremendous bubble in the stock market and in the credit markets and in the real estate market. The salient issue here isn't that we have a Federal Reserve that's defended the value of the dollar and the middle class and the purchasing power of our currency. We have a situation in the United States now where 60% of the population has either no net worth or negative net worth. Little to no net worth or negative net worth. 60%. And that's because of the inflation, which is directly laid at the feet at our government. And now the problem is, I'm supposed to, believe that we need to have Governor Waller come in May of 2026 and fix everything by slashing interest rates? Is that really the answer to rebuild the middle class of this country? Donald Trump did have a good idea. His idea on Liberation Day on April 2nd was to have these liberation Day level of tariffs. If he stuck to that, we would have had a depression. But maybe at the end of that depression, hopefully a truncated one, we would have a healthy middle class and a revitalized renaissance in our manufacturing base. But what he's doing now with, the tariffs are 145%, then they're 35%, then they're 50%, and then they're double that if you buy oil from Russia. It's chaotic. It's causing a huge tax increase. I mean, someone's paying Trump's always bragging about all the money coming in. Well, who's paying that? It's the importing company pays it, and then the consumer pays it. If the revenue is coming into the government, then it's not being eaten by the exporters, the foreign exporters. So we have now a situation where most of the people in this country are hanging on by their nails, their teeth and nails, trying to stay afloat, trying to make ends meet. And on top of that, we have tariffs, which really just went into effect today, Kai. This was the day that really most of the tariffs went into effect. So prices are going even higher for them. And what do they have to look forward to? More artificial manipulation of interest rates and more money printing and more inflation. It's terrible.
Absolutely. Like, it's not going the right direction. Like, you use the word depression. Jobs numbers have brought back the recession discussion, which, is the lighter version of a depression a year. What are you saying? Like, are we in a recession already? We've been talking about this for 3 years. And we just highlighted, like,
Kai, if you're in the bottom 4 quintiles, you've been in a recession. If you're in the top 20%, things are great. Our stock markets accounts are booming. Our real estate portfolio is doing fantastic. We are doing fantastic, and we're keeping the economy afloat. That top 20%, that top quintile. But the bottom 80% have been destroyed, eviscerated, and especially that bottom 60%, which have little to no to negative net worth. So as long as the stock market does okay, then we're going to have that top cohort participate in, all this consumption. But how long can a country and a nation be healthy with only a very small percentage, the top echelon, doing well? The time is limited. It is not indefinite.
You've been calling for a market correction. I want to pick that up because after Liberation Day, the market tanked significantly, actually, for an S&P 500. We dropped down to 4,800 points, top of my head right now. I personally thought, okay, this was the beginning of the end, but we recovered very quickly. As I said in the intro, we're at 6,400 points now, Michael. Who's buying that, and why has the market recovered so well? Why did nobody believe that this was a long-term downtrend?
Well, I'm glad that week between April 2nd and April 9th happened, because so April 2nd was the announcement of Liberation Day tariffs, and April 9th was the effective date. And between then, the market lost, the S&P lost 15%. I mean, it was just, it just fell off a cliff. And the credit markets also started to freeze. So Trump says they were getting yippee, or whatever is the words he used to describe the credit markets and the trading of treasuries in particular. So he had to reverse course. But it just goes to underscore and illustrate very clearly how fragile this bubble is. He made a proclamation about tariffs, and before they even went into effect, the markets and the economy began to shut down. So, of course, it was easily ameliorated by him just reversing course and say, "Oops, I'm just joking. This is all a game. So it's all 4D chess. I didn't mean anything I said. So we'll suspend everything for 3 months, and we'll talk about it later." But it just goes to show you how fragile the system really is. And here's the salient concern that I have, because I did say that the markets go. Here's what I'm saying: the market to reach fair value needs to drop by 50%. That's just fact. If you believe in reversion to the mean, history tells me that reversion to the mean always works, and nature hates vacuums, and nature seems to revert to the mean too. So it's just an immutable law. I mean, either the stock market goes nowhere for a decade and GDP and incomes catch up, or it crashes, and the two kind of meet. One of those things is going to happen. You can't stay with this kind of market where you have the market here and GDP here. It just doesn't work. It just doesn't work that way. So eventually that's gonna mean revert. But what I'm most concerned about is come next year when we replace Powell with someone with I call a obsequious sycophant who is just going to do the president's bidding, which really what banana republics do. Banana republics are highlighted by insolvent countries. Well, you could check that. That's a check. We check that box. Economic data that they report that you just can't trust because they just lie. Well, now we're being told that if you report the data, if you try to report the data accurately, even though your methodology is horrible and it needs to be overhauled, but if you try to do it correctly, but it makes the president look bad, you're fired. So I guess the replacement for Erica is going to be someone who's going to be very scared to report a bad number, right? I guess. And then you also have banana republics are marked by central bankers who just like do the head of state's bidding. Then you can check that box too. So my fear is that once all these things come in place and you have a central bank that's slashing interest rates on the short end, when inflation has been above the Fed's target for 50 months in a row, and it's rising further away from that target, and then you slash interest rates in the context of $2 trillion deficits, which are rising rapidly. We're gonna add another $30 trillion to the debt in the next decade, $67 trillion in debt. And at the same time, foreigners aren't borrowing our debt anymore because they don't have that trade surplus to recycle into our bond market. So all you're left with is gamblers, and institutional investors aren't even very long this market. It's all the meme stock gamblers. Hey, you just buy Palantir and Nvidia and you can retire next year. I'm 62 now. Next month I'll be 62. I've been doing this 35 freaking years, Kai. I've seen this before. I know how it ends. So I manage money for a living. We are net long, but I don't go off golfing every day and check my portfolio every month and then do some sales calls. I'm managing the money first, and then I'm trying to raise assets. They come naturally. I'm not a salesperson. you have to watch this thing very closely, because what happens next year if we slash interest rates and the long end of the bond market revolts, just like it did in 2024. The Fed cut interest rates by 100 basis points, and the long end said, we're not having it, right? So if the long end of the bond market becomes unmoored and that starts to spike, there's nothing. What's the Fed going to do? Cut rates even more and add more inflation to it? Maybe they can do some kind of operation twist, and they could, maybe buy the long end, try to cap it. But that would mean they have to even print more money, and the Fed's balance sheet has to go to, $20 trillion instead of stopping at 9 like it did last time. So the dollar is going to get wrecked, especially against hard assets. Inflation is going to soar. You're not going to fool the bond market. I mean, is the Fed going to assent to buy corporate bonds too? How about municipal bonds? How about junk bonds? How about private credit? I mean, where is it going to end? So something is going to have to give. And in that case, if the long end spikes, mortgage debt is priced off the long end, auto loans, student loans, and corporate bonds are priced off the long end of the bond market. So no matter what the Fed does, it could be an absolute unmitigated disaster for these bubbles if that happens. Now, am I predicting that? Am I etching that in stone? No, I'm not saying that's going to happen. I'm saying it's a salient risk. It's a significant risk. And if it happens, I will monitor it. I will act ex ante and make sure my clients are safe. But most individual investors will get wiped out, because you see how fast and fragile this is. We live in a new world now where, bids just hit a button, bids disappear, and, you're down circuit breakers on Wall Street. That's going to happen. You're going to hit the NYSE circuit breakers down 7.5%, close for an hour, down 13%, close for the day. Something like that's going to happen. That's my fear. And I'm not trying to scare you. I mean, I'm just saying, listen, don't believe me. Believe Warren Buffett. He's a little smarter than I am, right? Warren Buffett has an indicator. It's called total market cap of equities to GDP. It's now 209%. And go back to see where it was go back in the NASDAQ bubble. It was only 140% before the NASDAQ lost 80% and the S&P lost 50%. Go back to the start of the great global financial crisis, where it was only 104% of GDP. Now it's 208% of GDP. This is in the thermosphere of valuations. That's not only that, Kai. It's the CAPE ratio. It's the price to sales ratio. It's the what's the other one I love to look at is equities as compared to the inverse of the PE ratio, which is the earnings yield, is now negative. So risk premiums are now negative. So you can get more out of owning a T-bill than you can on the earnings yield on stocks. The dividend yield on stocks is at a record low or very close to it. So don't believe me. Look at the data I just mentioned, verify it, and say, oh, this guy's got a good point. In fact, there was a guy on Bloomberg this morning who says, one of the nice interviewers said, it's kind of bubblicious out there. It's kind of frothy prices. What do you think? Oh, no, if you take out the tech stocks, which are, a separate issue, then the market's only trading at 20 times earnings. Well, let me see. So if you take out everything that's in a bubble, the market's still in a bubble, because 20 times earnings is still very rich valuations. And that means the market's going to crash. But taking out everything that's in a bubble, is that something you should really do? Listen, of course AI is real. Of course it's going to be a big productivity boost. But the same thing could be said for the internet in the year 2000. And I'm not saying the NASDAQ, because the construct of the market is better this time than it was 2000. So maybe not by 80% is it going to fall, but could it fall by 40 or 50%? Absolutely, no problem. And in a recession or a credit crisis, you will see it happen. You'll see it happen quickly. You better pay attention.
Michael, you touched on T-bills in the bond market. Let's go there for a minute, because back in March you mentioned that you got a lot of money parked in short-term T-bills. Has that strategy changed? Are you still happy with what you're getting out of it?
Well, finally, we were just taking that money in. So I have some money in T-bills, but I went out. If you remember, I said I'm going to 1 to 3 year treasuries. So I got a little bit of duration, but I didn't go out all on the end of the yield curve, because it's just too fraught with danger. So finally, when the BLS got religion, and said, "Ooh, we've really overestimated. They did it last year too. They did it in August of 24. They said there was 800,000, some odd less jobs than they thought. So they do it all the time. Their model, the birth death model on the BLS is broken. They just make asinine assumptions about how many businesses are created on a net basis. So they just assume the jobs are being created, and then they go back and get the real data and they go, "Oops, we made a mistake." That's what's happening here. So when they reported that was some 248,000 or something like 258,000 less jobs in 2 months, we overreported the jobs. We said it was like 100 and something thousand, and it was really like 19, for June. And so that sent yields crashing, prices up, yields down. So we really cleaned up last week on our long duration, the shorter duration bonds. So yeah, that was a very good move, and we still are. I still think that we're going to have some obsequious sycophant come in next year. He's going to take the Fed funds rate down to 3%. Right now it's at 4.25, 4.5. So I wouldn't be surprised if you see the 2-year note down to 3.5, somewhere around that range. So there's still some room left, and we'll look to profit from that. But I would stay away. I mean, maybe the long end depends how weak the labor market gets, and clearly it's weakening. We had the initial claims out today, and it showed that continuing jobless claims were the highest since the end of 2021. So clearly the labor market is deteriorating. You look at the household survey, by the way, in this last unemployment report that showed a big loss in jobs. Labor force is shrinking. We don't have a very strong labor market anymore. And why would you expect that? I mean, it's easy to predict. With deportations and border closures, you have half of GDP growth is in the toilet, because half of GDP growth is labor force growth. So 1/2 is productivity and 1/2 is labor force growth. Those are the two inputs to GDP when you think about it. That's the only way you can grow your economy: more people working and more people being productive. And there's just not many people working. There's less people working now. In fact, the roles are actually shrinking now. So not a very strong economy. But if we do get a very weak economy, you might see the long end of the bond market prices up, yield down. But I think it would be a very truncated condition, because when the Fed comes back and starts cutting to 1%, and then they do QE and ZERP, I think inflation is going to go well into the double digits, and the long end of the bond market is going to go much higher.
While we're on the topic of bond market, the Treasury wants to introduce stablecoins. Any thoughts on that, real quick? Any opinion on that matter?
You had to go there, Kai.
I know.
Okay.
I know.
All right, let me give you
another source of liquidity for the
let
government.
me give you
right?
as short answer as I possibly can. So the value of the value of cryptocurrencies was supposed to be that they gave you an alternative to the dollar, right? One of the things was, hey, let's buy these cryptos, and it gives you an alternative to the dollar. And by the way, it's decentralized. These transactions are decentralized and immutable and anonymous. Ooh. So Wall Street doesn't know what you're doing. The government doesn't know what you're doing. And you can preserve your currency's purchasing power because of the 21 million units in Bitcoin, unless they have it again. I don't know. Listen, tell me how any kind of coin, cryptocurrency, gets its value from linking it to the very thing it was supposed to give you protection against. Why link a cryptocurrency to the dollar when the dollar's lost 97% of its purchasing power since the Fed was institutionalized? So I don't understand that. And then the only reason why cryptocurrencies are going up is because the president has a big investment in them, and he's now going to let what can go wrong here? The president is now pushing for 401k plans to invest in private credit and cryptocurrencies.
I think he signed the bill 90 minutes ago, Michael.
Again, please save me the BS emails. I don't want to hear it. Okay, I voted for Trump, and I support the president. I think he's far better than the alternative, far better. But can I be objective and say this is a very bad idea to put This is the most volatile investment that the planet is aware of is cryptocurrencies, and they're going into your 401k plan. Private credit and private equity is private. It isn't. It doesn't. It's illiquid by its very definition. What is it doing in your 401k plan? Because when you need to get out and you need access to money, it ain't going to be there. And if it is there, it's going to be there. It's going to be available at a very bad price.
Let's switch topics. It's a difficult one. Stablecoins. I'm still wrapping my head around it. But gold futures just broke through $3,500 about 20 minutes ago or so, Michael. Gold is catching a bit again after it dropped after a hawkish Fed press conference here. It dropped quite a bit, and now we're really, recapping the gains here. What do you make of gold and silver these days, Michael?
Well, I mean, if you don't own any gold, you just made a big mistake. I mean, it's outperformed the S&P 500 with less volatility since the year 2000. So maybe you could say it's a fluke, year or two or 10 years, but a quarter of a century, gold has outperformed the S&P 500. That's that's astonishing. So you better get some, because with the writings on the wall, we have an insolvent nation which is incapable of controlling its inflation problem. Both those things are going to get much worse over the decades, coming years and decades. So I know you didn't want to talk about cryptocurrencies anymore. I don't really know how you feel about them. Maybe a big part of your audience loves them, but I'm just going to give you the truth. I can only speak from my heart of how I feel, and I could be wrong. Listen, if you want to ask me about cryptocurrencies and what to do about them, do the opposite, because I have been dead wrong on the price. They're dead wrong. Just to me, it's a glorified passcode. It's just a bunch of numbers and letters. I mean, you can write them on a piece of paper. They're private key. I mean, whoop-de-doo. I mean, but there's an unlimited number of cryptocurrencies and blockchains that can be created. So, but all I'm saying is that they don't belong, in my opinion, they don't belong in your retirement fund. And there really is there's nothing like gold. You cannot create gold. There's no more of it. It's more and more difficult to mine. It's virtually indestructible. And it's extremely beautiful. It's actually, it's malleable, it's ductile, you can make jewelry out of it, it's tangible, it's beautiful. And by the way, so is platinum. Platinum is actually more rare. It's rarer than gold. And it's actually more durable than gold. So that's another thing. I mean, hard assets are going to explode, I think, in the coming years and decades. And because we just don't have the ability to balance a budget. We don't have the desire or the ability to have real, a positive interest rate. So real interest rates in positive territory. Just don't have that ability, because when you do that, your bubbles collapse. And then, of course, when your bubbles collapse, the banking system collapses. And if the banking system collapses, the Fed, that's what the Fed isn't there. That's what the Fed's there for. So we have a Fed. So I don't anticipate any of this to change unless you had someone with someone who says, I am going to be president of the United States. We are going to have a depression, and we're going to wring out all the excesses, and it's going to be a terrible 2 or 3 years, like the banking crisis of 1907. And you know what? But we're going to have a real economy with a stable currency. And I don't mean stable coin, stable currency, and low taxes, low interest rates, low inflation, no asset bubbles. People can actually afford a house, a viable middle class. All those things can happen. But you're gonna have to trust me. You're gonna have to just, I don't know. It would be a brutal few years. But no one, hey, Kai, don't worry. Nobody's asked me to run. So don't worry about it happening.
I'm not sure the U.S. is in that bad of a spot just yet. It's like Argentina was. They voted in Milei. They seem to be doing all right now, or at least on the path of betterment, if that's even a term, right?
Yeah, great point. So until inflation becomes the pernicious issue, well then, hey, why not? Why do we have a 2% target? Why not just raise it? Make it 3. Why not 5? Isn't 5 better than 3 because it's higher?
Should be logical, right? No, Michael, really appreciate the conversation. Always fun to catch up with you. Always insightful. Where can we send our audience to follow more of your work?
So the website is pentoport, P-O-R-T.com. I have a midweek reality check podcast, which I publish every Wednesday, and you can get that for $50 a year, and you'll get real data that that you don't hear highlighted on the mainstream financial media, and my very objective analysis. So again, politically speaking, I might like somebody, but I'll criticize them. I might like a policy, I'll criticize it, and I'll let you know exactly what the market is doing at that point, based on the second derivative of inflation in the context of growth. This way, you could stay away from the real issues. The real problem is going to be either a recession or a credit crisis. That's where you're going to lose a lot of your money. The other problem could be intractable stagflation, which I think that's good. That's a very real risk too. So I think you're going to have both those things at different times. They require diametrically opposed investments. So on one instance, you'd want to buy bonds, and the other instance, I will be shorting bonds. So I will manage your money under the inflation deflation economic cycle model. If you have $100,000 and you are a U.S. citizen and you qualify for the portfolio.
Fantastic. Michael, thank you so much for joining us. Always great to catch up. And everybody else, thanks so much for tuning in to Soar Financially. Hope this was educational and insightful. Hope you're off better now. You know what's going on in the world. If you enjoyed this conversation, leave a comment, leave a like down below, and let us know, how are you positioned right now? Where do you think? Recession, depression, stagflation? How are you modeling your portfolio? Let us know down below. And I always read the comments, by the way, and I try to use your comments to add them into the conversation here with our guests. So please keep commenting. Much appreciated, and we'll be back with lots more. Take care out there.